Good afternoon, everyone. Welcome to Credit and Real Estate Today. I am Abigail Bridgeford with Genuine Property Solutions Real Estate, and I am joined with the distinguished Kevin Lewis of Primisien Credit Counsel. And today we are going to do things a little differently. As you can see, I am sitting down in my comfort zone here, and I'm looking forward to being able to comfortably within this air-conditioned environment to talk to you about how you can avoid foreclosure. So let's get started, shall we? Now, if we were to just take a moment and think about how serious of a subject that we're going to be discussing. So life happens, things happen in our lives that sometimes we can control and sometimes we can't control. So looking at the screen, our minds are like a puzzle. We're constantly trying to put things together. We want a full picture in our lives, and oftentimes the picture is clear and sometimes the picture can be a little fuzzy. Get married, you have children, you change your jobs a couple of times and you're trying to get money, and then ultimately you're trying to purchase a house. I get it. So in this discussion today, first we want to set a tone. One, foreclosure is never necessarily your or anyone's fault. We don't want to point the finger at anyone. We don't want this to be a conversation that's going to have a negative connotation. So therefore, I'm going to avoid discussing things that perhaps might come off as just say negative. I'm going to stick with that word, because what I want everyone to realize is that I'm not going to go into how the foreclosure process, the Act 91 letters and all that, the bank, I'm not going to discuss that because that's a conversation for another time. That's why our subject is how to avoid foreclosure. Okay, so take a moment and think about your own personal lives and see where you are in your life and which piece of the puzzle seems to be missing for you, and what it is that may cause you to lose or possibly lose your home. So we're going to discuss 6 different ways that you can keep your home. Okay, so first option we're going to talk about is seeking assistance from the HUD-approved housing counselors. Now, what most of you don't know is when you apply for your mortgage in the first place, towards the back of the package, don't know why they put it in the back, well, I kind of did. When you're buying your house, the excitement is you're buying a house. So the banks don't want to stress anything about you losing it. But if you look in the back of your mortgage package, there's going to be housing counselors that's listed there, phone numbers there that you can call, so that if you ever fall into a situation where paying your mortgage is difficult, they're there to help. So they're HUD-approved housing counselors. That's important. HUD is the Housing and Urban Development, and they are positioned by the government to help people to stay in their house. So there's certain criteria and guidelines that they must follow so that you can ensure that you're being given the correct information, because there's a lot of companies out there, and I do mean a lot, of people who want to capitalize on people who are behind on their mortgage. It's sad. It's just the world we live in. But people see that you're behind your mortgage, they say that they can help you. Please make sure that you use a very reputable resource like a HUD housing counselor. And the nice thing about the HUD housing counselors is that there are plenty of them in our neighborhoods. Now, the second option that we're going to discuss is negotiate a mortgage repayment plan. You might say, negotiate? The banks don't listen. That's not true. First, the bank do not want your house. Okay, banks are not in the real estate business. They're in the money business. Their money is being tied up and held up into this property. So therefore, they don't want that. They want the liquid capital. So if you go to a HUD counselor, or if you are in a position where you can negotiate your mortgage payment, if they want to help you get to the point where you can at least start paying something. So I'm going to make a statement that may seem a little bit like, what? What are you talking about? I'm just prefacing it now so that you'll be understanding. The bank are decent people. I know, right? The bank, people who work at the bank, they're decent people. Every time you run into a problem with your mortgage, call the bank, call your mortgage company. Being silent is the worst thing you can do. Being silent, because the bank is an institution, they have already have this feeling. Think about it. Let's think of this from the perspective of the bank. They lent you $200,000. You can't pay them back for whatever reason, children, college, health, medical, whatever. And you don't say anything to them. And the bank, now let's put, you loan me $200,000. Let's turn it around. I loan you $200,000. And you don't call me back. You don't say anything. What am I supposed to think? I'm going to think you're not trying to pay me back. So, bank, let's go. Run into a hard time, pick up the phone. Hello, my name is so-and-so. Here's my account number. I know I owed you on this and this particular date. What arrangements can you make? The bank will find some way to help you work out a resolution. The bank do not want your house. So if you do that from the first missed payment, it's so much easier, because the other options that we're going to discuss are options that comes when you miss more than 3 payments. Okay, so let's call the bank before we get to the point where we're missing 3 payments. Option 3 is a loan modification. Now, you might say, well, what's the difference with what you just said? You said call the bank and make a repayment plan. Okay, granted, sounds like it's similar. The difference is a loan modification is a totally new loan. It's pretty much the bank's way of saying, okay, we'll just start all over again. So if you owe, let's just say hypothetically, $50,000 on your mortgage. That's a small mortgage. So by the way, for those of you in our virtual world there and those who are in person, you get a 30-year mortgage. Things happen 10, 15, 20, 30, close to 30 years in. People actually foreclose and lose their houses only having 1 or 2 years left on their house. That's sad, isn't it? So this conversation is for all of us. This conversation is not just for people who just bought their houses, for people who have had their houses for many, many years. Foreclosure can come at any time as long as you own the bank. Okay, let's get that out there. So a loan modification, if let's say you're 20 years into your mortgage, things been going good for you, and then all of a sudden you have a real medical crisis that makes it very difficult for you to pay your mortgage. The bank will say, okay, you owe us 50. You're behind 10. We'll give you a new mortgage for 60 and add on that the fees that is owed from all the time that you've been behind. So now you have a new loan. In most cases, sad to say, it's a higher interest rate because it's later than when you bought it originally. And they will say, we'll stretch it out over a longer period of time, which means your payments will be smaller because it's being stretched out longer. And then this is our way of working with you so that you can make your payment. So let's ask some questions at this point, because I know we've talked a lot. Can I get your question, please?
Absolutely. So are there instances when the lender will tell you not to pay the original mortgage while you're going through the loan modification process? And let me back up. This probably Preface question. Is the loan modification a process that can take some time?
Yes. So the question that was asked is this loan modification process something that can take some time? I will tell you, yes. It would take approximately 3 to 6 months. And I'm going to tell you why. First of all, think about it. You might have a hardship and you might miss your payment, but the bank is trying to make sure the validity of your claim has some merit. I'll give you an example. You might have, decide you want to go to Atlantic City one weekend and you spend your money and you overbet at the, at the casino. And so now you don't have your mortgage payment. So you're behind. Well, the next month you say, well, I'm not going to Atlantic City because I learned my lesson from before, but you're still behind. So the banks will let you go a little while to see if this is really a hardship for you, or is this just something you want to do? Because in that case, everybody would just go and just get loan modifications. So it takes a little process. You can go anywhere from 30 to 90 days. However, if with your current mortgage, and we can know when we talk to Kevin about credit, he'll be able to explain to us about that. That mortgage is still being paid late and your credit is still being affected. In the loan modification process, they understand that your credit's not going to be perfect, but they'll never, ever tell you not to pay that first mortgage. They won't tell you not to. But what they will say is if you pay that first mortgage, then it's no longer considered in arrears, then you no longer qualify for a modification. So it seems a little awkward. And so basically the choice is up to you. Most people, in order for them to get through to the loan modification process, opt not to pay the current mortgage because the situation at that point is so dire. If there's a way to keep your mortgage, and it's especially if the interest rate is better. Using that same illustration, which was a very excellent question, if there was a way to keep your original mortgage, as we mentioned in option 2, and just renegotiate, that would be the best thing to do because the interest rates probably are lower, the fees are lower, and you can possibly see yourself getting out of your situation in a relatively shorter period of time. A loan modification product in some cases puts you back a little bit. It puts you back in debt another $10,000 or $15,000 because the banks, remember, they're banks. So they're not modifying your mortgage simply because they like you. It has to be something in it for them. So it's going to cost you more closing costs again, just like you initially had closing costs when you bought your house. It's going to cost you closing costs again. And you're going to end up having, yes, a smaller payment, but you're going to have it for a longer period of time. It's in either case, these are situations, it could be to your advantage or maybe not to your advantage. That's why we have 6 options. So let's go to option 4. Option 4 is an option that I have seen a lot of my clients used. And the reason for doing so is, I'll give you some scenarios. First of all, a deed in lieu of foreclosure, your deed actually is yours, even though you haven't finished paying for your property, you have it. And when you finish paying for your mortgage, then the loan or the mortgage or the note, as it was, gets fulfilled, and then that loan is released off your property. But you have a deed. What you're basically saying is, listen, I see no way possible for me to pay you back. I mean, my situation is such where I relied on my husband's income. He passed. I've never worked at all. It's just no way I can ever pay you back. A deed says, listen, I'll give you, the foreclosure says, I'll give you the deed in my house. And if you just say, we'll just call it quits. I don't owe you anything. You have the deed, you own the property. Kind of intense, huh? It can be. Cash for keys is the bank says, listen, it's obvious you have no intention of paying us back. And the foreclosure process is very expensive. Banks pay a lot of money to foreclose on you. So they want to avoid that. So they say, I'll give you $5,000 for the keys to your house and your deed. All I need you to do is get out of the house. A lot of people take that option because with cash for keys, you can negotiate how much cash you want. So you can say, well, it costs me X amount to pack, to move, to get moving truck, and by the time you add up things, you can say to the bank, okay, listen, I owe you $100,000 on the mortgage, but if you give me $10,000, I'll give you the keys, I'll give you the house, and I'll be out of here.
And no credit impact.
And that's where we go to our next point. There could be a credit impact. Could. Under tax and credit implications, depending on the amount, there is a maximum amount that the bank is allowed to give you that you can have. So it depends on how much your mortgage or your balance is on the note. So if the note is, let's just say you owe X amount of dollars down to X amount of dollars, the bank have certain ways that they write that up off for insurance purposes. Then, as we know, we have charge-offs, which Kevin's going to talk about a little later on. I'm so excited. That's why you don't think we do this. We pair these situations up for a reason. What we do is, so the bank will tell you based on how much money you're asking for and based on how much money you owe them, what your tax or credit ramifications will be. On your credit report, it will report as zero balance, meaning you don't owe them, but it will say it was charged off. Basically, it'll tell them what had happened with that money so that everyone will know. It doesn't mean that you didn't owe it. It means that everyone made an arrangement, an amicable arrangement, and that the bank is not going to ask for that person to pay it. Now, I did have it happen with one of my clients that on their credit report, it did still show that the balance of the mortgage was there. And they did do a deed in lieu of foreclosure. And we had to notify the bank that you can't have both. You can't have it where on the credit report, it shows that it's still something owed when the bank owns now the property. You can't have your cake and eat it too. So there are some situations that I would advise a client, you know what, you really don't want this house. You can't afford this house. This house is too big. You don't have the money, whatever the case might be. They'll give you your first month and last month's security or wherever you're moving to. I think you might want to consider the cash for keys. So it's an option. All we're talking about is options here. Any additional questions? So let's talk about option 5. Option 5, you hear that a lot, short sales. Short sales. Well, a short sale is a situation where because market conditions fluctuate, and as we know, especially now, they're really fluctuating. You could buy your house for $40,000 and 30 years later, now your house is worth $400,000. That's great. Well, did you know that there are some people who buy their house for $400,000 and today their house is worth $200,000? Yeah, the value of the house went down 50%, some cases even more, depending on what's going on in the neighborhood. So you've been in your house for, let's say, 15 years, and you're thinking, I've been paying my mortgage, but now things gotten hard, things got difficult. What am I going to do? And the bank sends out an appraiser to see what your house is worth. And you find out that your house is worth less. I will tell you, as a seller, you get zero. I'll say that again. If you do a short sale, the seller is not allowed to walk away with any money. None. And here's why. Using the same example, you owe me $200,000, right? And I found out now the house is worth $100,000. How much am I out? I'm out $100,000. That's me. I originally loaned you $2,000, and now I'm at a deficit of $100,000. Why should I give you anything? You never paid that money in the first place. This is my money so that's the bank's mindset. They loan you the money to buy the house. The value of the house done went down, and they haven't gotten their original investment back. So the seller gets absolutely fucked. On the credit report, and Kevin may touch on this a little bit, so I'm not going to delve in too much, but on the credit report, you will see that too, where a person it'll say agreed, or it'll say on the credit report, not paid as agreed, but it'll say that they reached an agreement. Like, how is it worded, Kevin? It's a certain terminology that's used on the credit report when the banks accept a lesser amount. And
So settle for less.
Settle for less, or settled. Thank you. That's why he's the credit professional. I just do real estate. So when it's settled, it doesn't mean that you didn't owe. And in most cases, you will get what is called a 1099, which you're going to say basically report it as income to you, and you would pay taxes on that income, because you basically the bank eradicated, in this case, a $200,000 debt to you. So you didn't owe it. So they're going to pass that on to you, and then the bank is going to write off what part of that they lost out on. So there are credit report and tax consequences with a short sale. But the good thing is it doesn't show up on your credit report as a foreclosure. That you want to try to avoid at all costs. Do we have any additional questions? Let's see if I can look on our viewing audience to see if there's any questions. Okay. Now, let's look at our last option. I'm sorry. Oh. Excuse me, audience, I have a little technical difficulty, but we're going to work it out. All right. Option 6, one of my favorites, not because you're going through foreclosure, just simply so we can avoid. Remember, we're talking about avoiding foreclosure. Sell it. Now, we talked about some instances where the house might be worth less, but there's a really good chance that the house is worth more than what you bought it for. I get it. I actually know someone who went through something similar, where they was on the verge of foreclosure, and they went down the line. Their children was married in the house, how hard it was for them to get the initial down payment on the house. The house has been in the family for many, many years. It was so emotional. It really was. But what was more emotional? When I saw the sheriff come to the house and change the locks on the house, and he had an oxygen tank on his face having to leave the building. I will never forget that day. And I told him, I said, listen, all you had to do was sell it. His house had a balance, I believe, of $22,000 on it. The house was worth at that time $150,000. Yeah. When we think about what we're trying to avoid here, avoid foreclosure, it's really okay to sell a property, get what monies you can get from it, give the bank whatever they're entitled to, have very minimum credit ramifications, not have to report no additional income per se to your to IRS. It has to be under $250,000. Just put that disclaimer in there. If it's over the $250,000, then you might have capital gains, but let's just make that clear. But in his case, he could have sold his house, paid the $22,000 off, and had more money to live off of and buy something else if he wanted to. So selling the property, there are advantages of doing that. So remember, we want to avoid foreclosure. That's what we're trying to do. And if you do these 6 steps, the happiness that you will have that you avoided foreclosure, we would, one, if you talk about HUD counseling, negotiating your mortgage, renegotiating, doing a loan modification, deed in lieu, short sale, or just sell your property. There's more options out there, of course, but these I felt were the ones that are mostly used, that's used most often. And come and see us at Genuine Property Solutions Real Estate so that we can perhaps have a discussion and see which of these 6 options are best for you. We don't want anyone in our communities, anyone, to lose their homes. So without any further questions, we'll take a brief little intermission and we will be having Mr. Kevin Lewis from Primisien Credit talk to us about charge-offs.
Stop. Okay, stop. You guys may see this on our social media platforms. This is my good friend, Abigail Bridgeford and Amber from Genuine Property Solutions Real Estate. And you guys know me, you guys know me, Kevin Lewis, Primisien Credit Counseling in this capacity. And so we are in another installment, our 7th installment of Credit and Real Estate today. Today, Abby gave us some incredible information about avoiding foreclosure. That's a major conversation. So if you get a chance, please make sure you go and check out her YouTube channel. All right. So today I'm going to be talking about charge-offs. They are very basic, but there's some things and nuances about these charge-offs that we're going to get into. This is going to be a very brief conversation, but it's going to be powerful. So charge-off, what is a charge-off? You guys have seen this on people's credit reports, not yours, because of course you guys have stellar credit profile. But what is a charge-off? So I'm going to go through the slide, but I'm going to talk to you in a conversation. So charge-off, all banks that lend have, well, let's not say all banks, because that's a blanket statement, and I don't want to make statements about alternate lending, which are also banks. But many banks have the ability to write down debts to the IRS. Now, for those of you who are involved in business and are business owners, you might understand that business owners don't get refunds, tax refunds. Generally speaking, you don't get tax refunds. what you get is a reduction in tax liability, right? So what you're trying to do many times is you're trying to reduce your tax liability to zero so that you don't have to pay any taxes as a business owner. But that has some challenges with it. In any event, if you are paying taxes, you might end up at the end of the year with a $10,000, $25,000, a $100,000 tax liability. And as your business grows and expands, that tax liability might be even greater. Well, banks have millions of dollars worth of tax liability. And they are trying to write down some of those tax liabilities. In other words, they owe millions of dollars at the end of the year, and they're trying to reduce the amount that they owe every year. One of the ways that they do that is the banks have lobbied Congress so that they can write down 75% of their outstanding debts to reduce their tax liabilities. In other words, if you have a credit card and you owe $1,000, the bank can dismiss or charge off 75% of that. So 750 of those dollars, they do not have to claim as income, right? That's called, so now, that is how the bank deals with the IRS. How the bank deals with you is it says, well, since I was able to write off that tax liability, in other words, I don't owe the $1,000, I owe $250 for the tax on that $250, then they can charge off your debt. That means they are going to put onto your credit report that we do not assume that we're going to collect this debt. Now, when they charge it off, they're charging off the total amount. So let's move through. So the creditor believes you're not going to pay. The IRS allows the creditor to write off 75%. Creditors may decide to pursue the debt, but often they do not. Okay, so they charge it off. They put it on your credit report as a charge off. That means they are saying they don't reasonably expect that they're going to collect this debt. They're going to close the account. They're going to put it on as a charge off, but it doesn't necessarily mean it's going to go to collections. They may just leave it on your credit report. Now, they may still try to pursue the debt. They may still try to say, you have to pay us $1,000, but they only have to recover $250, really, right? And so you, knowing that, you have that in your toolbox to negotiate with them. Now, you negotiate charge-offs just like you negotiate collections. Only with collections, there's a third-party entity that is attempting to collect the debt. In this case, it's the original creditor, and you can do just like you did in collections, our collections conversation, you can do just like you did with them, negotiate and start at 50%. Go no more than 70% because you know they don't have to collect but 25%. But how you can fix a charge-off on your credit report. If you have a charge-off on your credit report, the first thing you do is the same thing you do with the collections. Write a letter to the original creditor and ask the creditor to show you the original contract and documentation that you did not pay the debt. Okay? Send that letter to them via certified mail. That creditor has 30 days because the Fair Credit Reporting Act says creditor has 30 days to respond to that letter. And if they do not respond, then you can have that charge off removed from your credit report. Now, banks know this rule in and out. So oftentimes they do respond within 30 days. Many times, though, they will respond. They're supposed to provide you with this validation documentation, the original contract and the non-payment documentation. Many times they can't get that together within 30 days. So what they'll do is they'll send you a stall letter. Amber, is simply a letter that says, you didn't provide enough information for us to identify who you are. All right? That's just a stall tactic. But you go back in and you write another letter that says, okay, you sent us a stall letter. You now have 15 days to respond. full. That is called trading time for money. Because this process can go on for months, 2, 3 months. The second option is trading money for time. We are going to settle the balance. We're going to settle, and we can do several things. We can settle in full. We owe 1,000, we pay 1,000. Now, in that instance, if you pay 1,000, the bank has made a profit, right? Because they wrote off 750. They only need to collect 250, but they collected 1,000 from you. But for you, you settle in full. That means it's going to be a much better mark on your credit report. Shows that, you know what, got into some trouble, things happen, as you said, but now you are going to make the company whole. That looks great. But if you choose not to settle in full, you can do what's called pay for delete. Pay for delete means you're going to pay a settled balance that you agree upon with the creditor, and then they're going to remove the charge off from your credit report. Now, there are no laws that says the lender has to remove a charge off from your credit report. It will come off in 7 years, and you may be able to get it taken off early, and we'll talk about that. But there's no law that says they have to take it off. What they do have to do is, though, if you pay for delete, if they agree for a pay for delete, that means you're paying a settled balance and you're going to get it deleted from your credit report. Okay? You can do settled paid in full. You're going to pay less than the amount that you owe, less than $1,000, but they're going to put on your credit report that you settled this balance in full. Again, making sure that it shows up the way you want it to on the credit report. Or you can have it show up as settled for less. It's settled for less. That means they are saying you did not pay us the full 1,000, and we're reporting that on your credit reports. Now, each one of these things looks better than the one after. Settle in full is the best thing. Pay for delete is the second best thing. Settle paid in full is third. Settle for less is fourth. The thing about negotiating charge-offs, unlike collections, you always owe the money because you use the credit. So you can't go in and say that you don't owe the creditor the money. In collections, you can argue that point because if you don't have a contract that says your original creditor has the right to transfer ownership to another third party, then you can use that to get a collections removed. But in a charge-off situation, you can't. You owe the money, you've already used the money. Now you're just trying to figure out how to make your credit report look good. And in this instance, you can choose either one of these things. When you negotiate this conversation with the creditor, however, you want to be graceful and professional. Don't go in there with an attitude. You owe the money. You didn't pay them the money. They were kind enough to lend you the money. So ask them graciously, hey, listen, I know that I had an issue, but I want to make you guys whole. I'm willing to pay the money now. Didn't have it then, have it now. I didn't have the money. I want to pay. I don't have all of the money now. I want to give you something, though. I want to make your company as whole as possible. But this is impacting my credit report. This happened 3 years ago. So get it deleted. I don't have the money. You don't do pay for delete. Can you put it as settled paid in full? No. Can you put it settled paid for less? Now, here's the thing. Once you pay the money, it's very important. Once you pay the money, then you need to monitor your credit reports. Because as you said before, the banks can't have it two ways. They can't have gotten money from you and still be trying to collect the full amount. So if you choose any one of these things, at minimum, the balance should be zero. If it stays on the credit report, the balance should be zero. And if the balance is not zero, then we've got an issue. And here's the deal. Once the balance is zero, a good credit counseling, credit repair, credit company, I know a good one, can have that removed from the credit report, particularly if it's more than 24 months. If it's more than 2 years, we can get those zero balances removed from the credit reports. But best thing you want to do is have them remove it if they remove it, and we don't have to do as much work. Question.
Approximately how many points would the charge-offs affect credit once it's removed from your credit report?
That's a great question. So they range from 15 to 40, about 40. Payment, so missed payments. Here's the thing about charge-offs. So I have a client right now that has no missed payments, but has a charge-off. And the question is, so why didn't the company think that they were going to reasonably get their money? Because you would think that, okay, the person must have missed some payments in order for the company to believe that they weren't going to pay. No, that's not what happened. What happened is the person kept charging the amount, but on a credit card, the minimum payment amounts can be $25, $35, whatever. But the person kept charging and charging and charging. It's a pretty substantial limit on this credit card. And so they just kept charging and kept charging, but we're paying the minimum amount. So now if you have a $25,000 limit on your card, but you're only paying $35 a month minimum payments, and you're charging thousands at a time, the company may believe at some point you're going to stop paying. But at whatever point, if you're paying $35 a month, you can figure like this. If you pay $35 a month and you owe, let's say, I don't know, $10,000, how long is it going to take you to pay $10,000, including the interest, right? Because interest is going to accrue every month. So the person did not miss any payments, but the creditor closed the account, wrote it off as a charge. So the answer to your question is anywhere from 15 to 40 points. The 15 is this scenario where the company just closed the account. They lost the credit age and they don't have enough credit mix. But how you fix it is simply pay them the money. And then we can get the charge off of them. All right. Now, this letter, if you're going to trade time for money, then you're going to write a letter. And this letter looks very much. Oh, that's it. For the document. Anyway, I'll tell you what that letter looks like. So it looks very much like a collections letter, but you're going to write a letter, and in the letter, you're going to say, please send me the original contract and the non-payment documentation. And you have 30 days to respond to this letter. Wait the 30 days, and then you write them back, say you didn't respond in 30 days, you have 15 more days. And then after the 30 days, I would call the company and say, let's take care of this balance, get this off your books. Any questions? All right, that's all for charge-offs. No questions? All right, so we're here August the 11th. We're here August the 11th, Friday, August the 11th. And believe, Abby, what are you doing on August the 11th?
We are going to discuss how we can estate plan with real estate. A lot of people have some real estate that's in people's names that we need to change. So that's what we're going to discuss next time.
Okay, and I'm going to be talking, I believe I'm moving into the business credit world. And I'm going to be talking about the business legitimacy phase of building business credit. So for the first 7 months, I've been talking about personal credit. The last 5 months, I'm going to be talking about business credit and showing you the power of business credit and how to use both of those things to positively impact your way of living. So stay tuned. Credit and Real Estate Today.
I thought I put